Good morning, everyone. This is CA Mohit Jain. Welcomes you all to today's webinar. And I feel privileged to be your moderator for today's webinar on understanding angel investing and enhancing capital building, organized by the Committee of Members in Practice of ICAI under the guidance of our two chairmen and vice chairmen of this committee, CA Madhukar and Hirginge sir and CA Satish Ji Gupta sir. As professional, we often deal with number of audits, tax and compliances. But today, topic takes us a step beyond into the world of capital, where capital meets creativity and where risk is not just calculated, but it is embarrassed. Friends, in today's world, startups are no longer a buzzword. They are a parallel economy even. And angel investing is a seed of belief planted early with a hope that it will grow into a success story. As we, as we all saying goes, जोखिम उठाने वाले ही इतिहास रचते हैं. And in our case, VCS can be also the ones who can advise guidance, who can advise even in investing in these journeys. Today's session with the learned and eminent speaker, CA Chetan GMS sir, in today's session, he will open up with the possibilities. He will open up within our mind the possibilities. What are the main SWOT analysis upon this angel investing? To start this session officially, I would like to have a privilege to introduce the chairperson of this committee of members in practice of ICAI. Before we begin, it will be a great honor to introduce CA respected Madhukar and Hirginge sir, the chairperson of this committee of members in practice of ICEI. Sir, your constant efforts to bring the relevant and emerging topics to the CA community truly show your forward-looking vision. And today's webinar is a reflection of that. I would like to thank you for encouraging us to look beyond the compliance and today's towards the capital building capacity of the members. To introduce, I would like to show a torch to the sun. It seems like showing torch to the sun if I'm giving a visionary leadership introduction to the sir. Madhurkar and Hirginge sir, with a 37 years of post-qualification experience, is the founder partner of HNA and Company LLP, an ethical ground growth-driven firm operating across 17 locations in India and over with 100 dedicated professionals. Sir is a co-author of 37 books, including 12 on GST, a mentor of who had created over 500 committed professional leaders. He is a Central Council member of ICI during 2010 to 13, 2026 to 19, and 2025 to 2028, currently serving to the holy body of our institute. A visionary committed person to MBNL capacity building with 10 new non-traditional areas for SMP and a champion of instilling strong values and attitudes in students and members. So I would like to have thank all the members, all the committee to have such kind of personality in between us, and he's here to support and guide us towards the his era, his aura, and his working capacity. Without taking much of your time, I would like to hand over this to sir to share us their words of wisdom. It's over to you, sir, Madhukar and Hirgengis.
You, Mohit, and if Chetan permits, I will take 10 to 15 minutes to introduce what all we are doing. I need permission from Chetan, otherwise I should not speak more than 2-3 minutes.
No, sir. It will be our honor to hear from you. Please. Thanks.
Okay, thank you very much. So I will not waste time. These webinar series, we have been getting excellent speakers, and today's speaker is no less. I also go to listen to him for as much time as I can. But let me tell you a bit more than what Mohit talked about our committee. What I have done is history. It's of no use to anybody. What I will do possibly is of more relevance. So we have looked at consulting as the focus area of the next 4 years. We have done enough in attest function. Attest functions are also good. There are compliances coming up in many specialized areas, and we should do it. But the jam, the peanut butter, the juice is all in consulting. And that is why we have looked at non-traditional areas in CMP to add value to the clients. After all, the clients are all here to make a bit more money. 99.99% of our clients want to increase their profit. A small proportion are there who are NGOs, etc., real NGOs. So if my client wants to make profit, how can I serve him? I am a person who is a consultant. I am a person who is a attester. How can I add value to my client? So we thought that one of the best ways of looking at that is by looking at where all they need support. We chose areas like the MSME. MSMEs, traditionally, they can't go to 10 consultants. Similarly, real estate businessman, whether he's a contractor, whether he's a builder, whether he's a landlord, none of them have time to go to 10 consultants. And most of them are uneducated, unorganized, and the whole environment is taking them for a ride. This is the truth. Unorganized people going to unorganized people end up spending 10 to 15% of their monies for something which they can do for maybe 2 or 3% of professional fees. This is a place where we want to come in to provide professional services more or less with a one-stop shop thought process. Towards this, we have started a course. We are preparing to start a course on real estate super consultant, MSME super consultant. Both are in progress. The real estate one, we have got around 300 pages of material written. Most of our projects have material also, just like we did in GST a few years back, which became a thundering success. So we want to replicate that in every area we do. These are two areas which will come up maybe in August, September, both of them coming into the into the course open. In the meantime, are we doing anything? Yes, we are. There is one program called Practice Ki Pathshala. Now, this is a program which was started in Hindi, and it was being held in COE Hyderabad and Jaipur. We have opened this program up for non-residential also. And we have added and improved the program. Again, in this program also, we are going to give you a workbook for the Practice Ki Pathshala, which will tell you how to grow your practice. And you can make notes in that book, which will become your Bible for your practice. Whichever stage of practice you are, as long as you are aspiring to do much better. For example, you are a proprietor, you want to become partner. You are already a partner, but not real genuine partner. Then how to take genuine partners, how to grow. This is what the course is about. We also have jointly with the GST committee, supporting them in running programs for GST dispute resolution in entire West and Central India and East India. This is our jurisdiction, that is the CMP jurisdiction. We have about 4 or 5 programs already slated, some in Bombay, some in Kolkata, a few in the middle region, Agra, etc. This is a wonderful program. Material ready, launched, you can take full advantage. The capacity building is our job. Taking advantage of it is your job. So you have to ask your particular branch, and if your branch falls in whichever place in India, either you will go to the GST committee or you will come to us for supporting. You will get a booklet, wonderful booklet. It's called Practical Guide to GST Audit Disputes. This book you will get, and obviously the faculty are all very good because these are all old faculty from the GST advanced courses and the GST certification courses which we have run for more than 6 years. We also have one more program called a Pathway to Practice, which is a little longer program, but we are seeing how we can make it useful to you, and maybe we'll try the online version. I'm not very sure. Other than this, we are doing an initiative for US tax outsourcing. It can be not only US tax, it can be UK tax, it can be Australian tax. So we are seeing how we can do a course which will get you ready to get into this very lucrative area of tax outsourcing. We have not even got the subjects ready now. We have also thought of doing something post the MSME, which is called the virtual CFO. So you can become the virtual CFO first for companies in India and then for the world at large. But this will take again a little time. Maybe the world part of it will come next year. Indian part of it, we hope to finish off this year by Jan or somewhere, we'll start it. We have got this type of webinars which you are seeing today. We want to launch one more webinar series, which will be every fortnight, which will be on values and attitudes, which is very important what we see. In fact, we have included this in all our programs. We have one more certificate course in wealth management, and in that we are going to include this. Even in your GST dispute resolution, we have included some empowering thoughts there. So we are providing a number of what I would say facilities to you to come forward and take advantage. I have seen in many parts of India, people are frustrated. They say that bank audit is not coming and the income tax opportunities have come down. There is so much of virtual hearing. So slowly our opportunities are coming down. GST, no longer the client will pay you more for your compliance. But there are so many other areas. We are also looking at adding a small value-added program in FTP, that is Foreign Trade Policy and Customs. A 2 or 3 day value-added, how you can add value and serve the businesses. It is a very value-additive thing, and therefore it will also be very lucrative. Institute is also slowly getting into those areas, and ethics are being looked at, so as to ensure that, like the Big Four, we also can give quote percentage fees other than for a test function. So I hope that gets done soon, and if it gets done soon, then all of us, if we empower ourselves in some value additive area, like I talked about, whether I am a real estate super consultant, whether I am a MSME super consultant, whether I am a person who is going to get benefits for you under customs FTP or even in GST, or I am a person who will manage your wealth. Whatever I do, I should be able to get my just fees. I should be able to make myself visible, and the Institute of Chartered Accountants is trying its best, following up with what the government also is looking at, to remove the shackles from the hands and legs of the practicing chartered accountants so that they can compete on a level playing field. It may take 5 years or 10 years, but then we will also be as near to the Big Four as anybody else. You will be surprised to know the Big Fours, some of them in their consulting practice, they bill as much as 7,000-8,000 crores only in consulting. Their attest practice may be at most 1 or 2,000 crores. So we have lost all this. We have to regain it. And I hope that what we did in GST, when we took back what professionals can take back, and all of you supported, all of you provided fantastic services, we are now considered as the go-to persons for GST. We should also become the go-to persons for real estate, for MSME, for FTP, for customs, and we should also be able to, by providing some good courses to you, management courses, see that you can become the best virtual CFOs in couple of years' time. With that, I would like to thank Chetan for giving me some extra time, and of course the Institute of Chartered Accountants, and Priyanshu, our CMP team is quite strong. Shubham also, I can see he's there. So Shubham is a chartered accountant, and we have a nice team at CMP. And thanks to them, I hope to, see that about 100,000 chartered accountants are trained in such a way that their income from non-traditional practice in 2 years' time is double the traditional practice. This is my hope and dream. Thank you very much. Over to you, Mohit.
Thank you very much, sir, for your words of wisdom. We are very enlightened to have you on this portal to have guide on the members about this topic and the working pattern of the ICAI. Now, coming to our keynote speaker, someone who brings deep insight and practical experience to today's topic. Here we welcome CA Chetan GMSG. Currently CFO at a venture organization having an experience of 9 plus 6, 15 years in the field of the venture funding, having off-field interest in traveling, foodie, wildlife, and automobiles also. He has been actively involved in startups, investor networks, and advisory boards, and understands the full journey from idea to investment. In short, he does not just talk and talk on the talk. He had walked from this walk. So we are very fortunate to have him today to explain the angel investing in a way that connects to us as a chartered accountants and a future enables. Key discussions what we will be covering today during this webinar is what is the angel investing, brief overview, types of angel investor, structure pooling vehicles, investor structure and process, domestic and overseas also, exit mechanism, discussion upon the topic on members in practice, what services they can be offered, activities where members can engage with the companies where angel investors are investing. How can members help and engage with angel investor at the time of investment, where the subsequent rounds of investment of the company, and at the time of the exit from the company? So without taking much of your time and without any further delay, let's dive into today's session. Over to you, Sir Chetanji. It's all yours.
Okay. Thank you, Mohit. Good morning, everyone. Thank you, Madhukar sir and ICI and CMP team. It's a good initiative. Good to see that the CMP team and ICI is helping members and especially members in practice to look at other areas which have not been the focus all these years. So thank you so much for the initiative, sir, and wish you all the best. So let me present my screen, and maybe we can. So what is AI? It can be two things. The place where I come from, Bangalore, artificial intelligence is the buzzword. Everyone talks about it. Everybody wants to do it. So is angel investing. Bangalore and India, everybody wants to do AI. They want to look or use artificial intelligence. But angel investment is something to do what we hear every day about startups. We see a lot of news about this startup doing that, a lot of IPOs happening, many investors, foreign funding. So what exactly is this? So in simple words, artificial angel investing is you investing in a early stage unlisted startup company. As simple as that. Now, why angel investing? Why are we discussing it today? What is the relevance? See, India has become, as you know, India has become the third largest startup ecosystem. More startups are now originating. Every day you hear, even if you're not actively following, you hear stories, you hear news, you read the newspaper, something new you hear about startups. It's also good to see that more startups are now originating from tier 2 and tier 3 cities, while leading hubs like Bangalore, Delhi, Mumbai, Hyderabad, they are the preferred jurisdictions or locations. Also, currently, the startups are less reliant on foreign capital. I'm not saying that they are not, but it's good to see more domestic capital, more domestic investors coming in and taking a bet on early stage founders. There have been good moves from the government. We have the angel tax. We'll come to that. That has been abolished, which is a good thing. That encourages more startups to set up their companies in India. This is again one more topic. We'll come to it later. More people are coming back, and what do you call the flavor of the day is reverse flipping. More startups are also setting up now in India. So the regulatory framework is also good and encouraging. The government of India is also supporting it. There's a program fund of funds where they've earmarked some money which helps young founders to access capital. So all these things are encouraging. We are in the right direction. We are seeing more people starting up. Earlier, we used to see only those people coming from traditional business families who used to start up something new. But it's very encouraging to see very young kids straight out of college putting their hands up and diving into this. So that is about the landscape, the current landscape in India. Now, what is before this? I'll come to what is angel investing. Like I said earlier, you know someone who is starting a company or a business. He needs capital, and you put your money there. It is as simple as that. You are a partner with that founder or company whenever somebody starts up. Angel investor provides capital either in the form of debt or equity. More often than not, it is mainly in equity from his own funds. This is very important to a private business owned and operated by someone you know, right? So that's a very short, precise definition of what an angel investor is. Now, who can become an angel investor? I would say anybody can become an angel investor, and we are seeing that. There are few other regulations which SEBI has come up, wherein you pool in money into roll-up structures. SEBI has put in some regulations there. But coming back to what angel investing is, anybody who has surplus money and who is ready to take that risk and wants to support a founder or a business by providing capital is called as an angel investor. Okay. Now, coming back to whenever somebody starts a business, it can be anything. It can be a technology company, it can be a manufacturing industry, or any idea, anything, big or small. What are the types of funding they can look at? Like few years ago, if you'd asked the same question, maybe they would have looked at banks or any state financial corporations to help them with initial capital, right? Whenever somebody starts a new business, they need money to one set up a factory or set up a team, the basic initial infrastructure which is required. They need some money from external sources. So one is bootstrapping. Say somebody has got a saving, his own, he has worked somewhere, or he has got his own property. They can fund it themselves. This is called as bootstrapping. Second is you take it from your friends and family, which is very common. Say you're starting up something, you get it from your family, your close friends. They believe in you, and they tell, okay, we believe in you, and we like what you start, so take, this is the money we have from our savings or whatever it is, so please do start. So that helps kickstart the initial business. The third one is angel investors. So we're going to talk today mainly about angel investing, and maybe that will also cover friends and family, but we will concentrate on number 2 and number 3. But just to give a high level picture of what other kinds of funding are available is venture capital. That's what we as a firm do. Venture capital is they take money from other investors, they pool money, and they invest in early stage or whatever stage they are interested in. They invest in companies and back the ideas. And whenever the company grows large, they exit the company and make money. Crowdfunding is similar. This is a pooling where you open up your doors to general public. They can just pull in money and they invest in your company. Bank loans, which I've mentioned earlier, it's the most traditional form. You go to a bank, tell that you have this idea, they give you a loan, right? And lastly, it is grants from government and corporate funding. So this is just a bird's eye view of what today startup funding modes are. But let us go deep into angel investors and what angel investing is. So generally, who can become a angel investor? Anybody can. What is the amount which is required? It can be anything, as small as I've seen people investing 2 lakhs. But generally, a range is about 5 lakhs to a crore. It can be higher or lower. What kind of ownership can you expect? Again, it depends on what the valuation of the company you're going to invest in. It can be a range of usually 5% to 25% is what we have seen. 25% is too high. 5 to 10% is what a general range is. Risk profile. See, you're investing in an early stage company, right? The execution has to be done, the product market fit, everything, all those things have to fall in place. So it's a very risky asset class to invest in. So the risk profile is very high. And what is the average holding period? It can be anywhere between 2 to 8 years. And these are just high level numbers. It can be lower than this or higher than this. But generally, if at all a company is done well, you would like to hold on. And the average period, holding period is anywhere between 3 to 8 years. You can invest in both Indian companies as well as foreign companies. So why should somebody do a angel investing? What are the benefits? Like I mentioned earlier, this is a very risky asset class. So you should allocate your assets whenever you're investing judiciously, keeping this risk profile in mind. And because it's a risky early stage, the higher the risk, higher the return, the upside is also huge. You're backing a early stage founder, and if it does well, if you have more money to invest, you'll also follow up and invest more in further rounds. And once the company does well, and it say go for an IPO or a strategic acquisition, you can exit, and the upside is very huge. The paperwork is minimal. I'm not saying that there's no paperwork, but as the company grows, the complexity increases. The paperwork also becomes more deep. So initially, when you're investing in a company, the founder approaches few angel investors, and the paperwork on what rights you have as an investor, what other things, what are the exit rights, and all those will come to that later. It's very minimal, right? More importantly, the founder also looks to approach angels who give them not only money but also mentors them in the areas or the business they are operating in. So, as an angel investor, it is good for you also because you can apply your existing skills and guide and mentor the founders. It is also a good opportunity for the investor by becoming an entrepreneur without taking all the risks of an entrepreneur, right? So these are the benefits of why somebody should be doing angel investing. And before we go further, I want to, and I tell this whenever we have discussions, there's a lot of exposure to all of us with programs like Shark Tank and all being aired on TV and everybody watching them. That while this is a very risky asset class. If I have to give a parallel, if you are investing in in the stock exchange and you buy shares, say buy shares of Reliance or Tata, even if the company is not doing well, you have an option to press a button and exit out of it, right? But here, the exitability, if you want to exit, sometimes even if the company is doing well, is not that easy as what we have seen in secondary markets. So, like I mentioned, this has become the buzzword. There is more access to information. More companies are starting up. They are looking to raise more money. And Also, angel investors, I have seen earlier, we would have heard in the news that many actors, known cricketers, sportsmen, they have invested in XYZ company and they're doing well. So it's become more common now. It is not that somebody has a lot of money and they want to do angel investing. I've seen a lot of employees who are currently doing a day job. They have surplus money and they're also trying and investing in early stage startup companies, which is a good sign, right? What are the key considerations which one should keep in mind? Risk versus reward. It's a very risky asset. What are the structures and pooling vehicles? Are you going to invest straight away into a company? Do you want to pool up with, say, 10 other similar angels like you? What are the pooling vehicles? How does it impact you? Say one of you wants to exit, the others don't want to exit. What are the difficulties? What are the tax issues if you're investing directly or through a partnership or any other vehicle? Those things should be kept in mind. Like I mentioned earlier, it's very important for one to diversify their portfolio, not only in their unlisted angel investing. It can be into the sectors you are investing. You should not concentrate into one sector, say technology or something like that. You should also spread it also with other options you have, say real estate, gold, or even listed shares. It's very important to understand what you're getting into, right? Now, what exactly do you do? A company is starting up, a founder approaches you, he wants money, and you are ready to put money in there. Initially, the ownership is with the founder group. You get in, you get some shares and ownership in the company, and you should know what your ownership is today and what your rights are. Also, what happens to all your rights and ownership as the company progresses. Why I'm telling you this is, say initially you would have put money and you've taken 5% ownership in a company. That is not going to remain 5% throughout, right? If a company does well and they raise further capital from incoming investors, there's going to be some dilution. So what you have 5% today will reduce over a period of time. And obviously the company is also doing well. They're going to raise more money. So that's a very important thing to keep in mind. Also, what happens to your rights initially when you are the only investor? Like I mentioned, the paperwork is not that complicated. As larger investors, say VCs come in, PEs come in, you're closer to an IPO. The rights which you have, which you would have got at the time of entry, will change over the time gradually. So you have to be very careful and you have to understand what you are getting into. Also, lastly, is the exit strategies. What are the options you have? Whether you are entering directly as an investor or through some vehicles. What are the normal exit options? Obviously, it is an IPO. That's usually about 8 years plus. Sometimes the company has surplus money. They want to clean up the cap table. They want to manage lesser investors. They can do a buyback. Or you want to sell your shares, somebody else is interested, or an incoming investor has money and he wants to buy out. That is called a secondary sale. These are few of the exit strategies which an angel investor has. Lastly, the regulatory issues. What does Companies Act say? Have you got real titles to your shares? Were the shares allotted to you? Were the shares issued to you properly? Was the valuation in place? All the FAMA aspects, Companies Act aspects, income tax, you'll have to keep in mind. And that's where I think the members in practice or somebody who's done this before comes into play, which we'll talk about later. The angel investors should reach out to such people and get professional advice. Again, taxation at the time of entry and exit, right? What is long-term holding? What is short-term holding? We have seen a case where there were debentures issued, then there was a buyback done. So will that be normal tax, dividend tax, or capital gain? So all those you should at least be aware and consult a person who is aware of all these things and get proper professional advice. Now, moving on, what are the few entry options, instruments we have, right? And this is very important. because early on, the founder, he may not be aware of what the technicalities or the regulations may require you to do. Neither would you, right? So if you take an example of a tech company, he's an expert at what technology offerings he has, how the company will operate, all those things. But when you're putting money, what is the instrument you're going to get? The simplest one is equity shares, right? The second one is a preference share. We call it as CCPS. It can be partly paid shares, convertible notes, share warrants, CCDs, a few of them. As an investor, as an angel investor, when you're getting into the company, when you're trying to invest, if one of these instruments is offered to you, at least you should understand what the rights are, what are the underlying clauses which come along with each of these instruments. Now, summing up, frequently asked questions: what is angel investing? Do your homework, and this is for an angel investor who is looking at what we spoke till now is an angel investor who's trying to invest in a early stage company. Do your homework before investing. Make sure that you understand the company and the industry in which it operates. Get professional advice. If you don't understand, don't sign up to something which you don't understand at all. It is okay to ask questions. Diversify your investments. Look at what the exit strategy is of the company and for you as well. Like I said, the ownership changes and how much of money should you expose, because you're taking such a high risk at the entry stage, you should also be sufficiently suitably rewarded. So just understand what ownership you have at entry and during the holding period and at the time of exit. This is very important. It can be a rough idea. Nobody knows what exit value is going to be, but at least you can think and plan it out and discuss with the company. And lastly, I want to reiterate that this is a very risky asset. With high risk also comes high returns. So do keep that in mind. So let us now go to the second section where I would like to spend more time on what opportunities do members in the industry have. So here I would like to divide it into two parts, right? One is what opportunities do members in practice have to work with the angel investors directly, right? And what opportunities do the members have to work with companies where they are taking angel investment or they are having investors coming in. So let us divide it into two parts. The first one is again, like I had mentioned earlier, what advice can an angel investor look at when he's getting into the company at the time of, at the time of investment? What are the things we should look out for, and what all things can the member advise or do with the angel investor when the investment is held? I want to just explain what I mean by this. Is, say you invest in a company and they're doing business. It's a long game, right? So initially when you enter a company, they do well. They are expanding. They get in more investment. They expand into other geographies, line of business, everything. So it's a period of holding which the investor have is approximately say 5 to 8 years. What happens to investment in that period? Even if you're not investing or exiting in that company, there'll be a lot of corporate actions which will be taking, right? So there'll be an AGM, there's an EGM. Should the investor have access to annual financial statements? Will he have access to MIS? What are the board minutes he may not have unless he's a director. But anything which is happening in the company, he should have information regularly. He should get from the company, and what that information is, he should be able to understand. So that's where a member can step in and help the angel investor understand a few of these. And lastly, at the time of exit, this is very important. You have done all the hard work. You have stayed with the company. You have taken risk. What happens? What's the instrument? What's the taxation? What are the restrictions at the time of exit? You should understand. We'll go deeper into all of these. And post-exit, what has to be done? He has to file a tax return. He has to get some information from the company. All those things, as an advisor, you should be aware of and help the investor to understand and comply with. And lastly, portfolio support. Angel investors would have made investment in not one company. It could be a range of companies. How can you help the investor in managing his whole portfolio overall? Now, the second part is how can you work with companies where this investment is coming in? Again, early stage founders we have seen a lot of them not getting proper advice. Where should the company be incorporated? What kind of investors should be onboarded? This is the basic thing. We have seen a lot of news about reverse flipping and all. This could have been avoided if a thought had been put what business they are doing, where's the market going to be, rather than trying to reverse flip later on. What do I mean? Where should the company be incorporated? Where is the company doing business? So this is one basic thing which I think all the members should advise the founders, whoever is coming and seeking their inputs. What kind of investors should be onboarded? Are they foreign investors? Are there angel investors? Are there VCs? Are there any restrictions on the percentage of foreign investors you can onboard? Say multi-brand retail, there is a restriction. What is the restriction? Not only today. Say today the cap table. Cap table is the details of ownership. What kind of investors are in the company? Founders, investors, angel investors. It is not only today. As the company grows, you should give a high-level idea or input to the founder that hey, today you are having this is your cap table, domestic investors are this percentage, you hold this percent. Tomorrow as you do well, these kind of potential investors can come in, but you may want to take them, but there is a restriction regulatorily, you can't onboard them directly. What should you do? You can't refuse money, but you have to do business. So those kind of basic inputs you should give. Now say your investors may say, hey, we are all outside India, please register the company in India, we don't know Indian laws. But is it going to help you as a founder? Where is your business being conducted? Where is your revenue going to come? So all your tax efficiencies should be planned, and as chartered accountants and members in practice, these inputs should be given. And why I'm stressing on this is we see a lot of companies coming in, they are not even aware of this. I think as founders, they should also approach the right people who can give this kind of advice. And these are basic things when you're starting up, right? Second is now you have incorporated the company, you know what you want to do. You have discussed with raising money is a very difficult job. Nobody's going to give you money, right? So they are going to ask you 100 questions. So one on how your structure is, what's the taxation, what's your business, all those things. You do as a founder, he does all those things. Then the second step is you close this transaction. You have to onboard this investors, allot shares, and close the process. The founder has to close this process faster because he can't be doing this all the time. He has to concentrate, get back to his business, and do what he has been paid for. So the whole process, members should understand and properly guide the company and take the load off the founder. That is where the value add the founders will like. And help him close the transaction properly and within time. We will discuss on each of the points going forward. Like I mentioned, I would like to stress more and discuss more on what opportunities members have in these areas. The last one is there will be new further rounds. The company is doing well. They'll raise more rounds of investment, and the same process will go on. But there's also an ongoing support which the companies seek from members in practice, right? Okay. Now the first part, how sir, I'm not able to hear you.
Sir, you are on mute, Madhukar sir.
Okay. Sorry.
Yes, sir. It's okay now.
Now it's okay.
Yes, sir. Perfect.
Yeah. Chetan, you go to the earlier slide because this is enough. So what I wanted to ask Chetan in this regard is, Chetan, assume that I am going to do this work for companies who are looking for angel investment, and I will also support angel investors in their compliances, etc.
Correct.
I have my own practice, 20 years, 10 years, 15 years. I have made a good name for myself in Bombay or Delhi or wherever I am. as a person who is reliable. And with this particular background, when I work for these companies for say 3 years and angel investors also for 3 years, now I have got a good understanding of this. What is the chance for me that an angel investor himself will make me his partner? Have there been instances like that happening in the past?
Yeah. I'll come. A very good question, sir, and thank you for raising it. And I'll cover it further in my slide. Answer to
Okay,
your
thanks.
question is yes. And maybe if you allow me, I'll go further and cover it up as we proceed further, sir. But there's a very good
Yes, please. This was the thought process which I had, because what happens in among chartered accountants is we make a good name.
correct.
People also say your name is worth so and so and so and so and all, you know. But none of us sell our firms,
Yeah,
nor do we get into business. We continue to do what we are doing, whether it's consulting or audit practice. And after some time, we get old, and then that is it. So we don't leverage our brand name.
correct.
Maybe when you take up this aspect, you can also tell people if they have a brand name, what is it they can do? Because we have to remember that earlier the Institute of Chartered Accountants had a bar which was quite unreasonable on non-audit services also.
Correct.
Now what they say is you can break, not what they are saying, they are thinking of. They have not, it has not come in writing, but it will come in another 6 months. You will find a chartered accountant may have two websites, one for his audit services, one for his non-audit services. And in the non-audit services, he can as well become a partner in a angel investing firm, because those partners, they may find his brand name something which is they cannot get in another 2-3 years also. So they get a jump in the branding, and also such a person will be an invaluable asset for them in their own businesses. So please do cover this. Rest of it, of course, I'll be around till I can. After that, I will leave. So thanks, Chetan. I thought I will ask one question and then.
No, sir. Let me cover that. You raised a very important thing. Let me cover that so that we don't lose it out later. And I have a note on that. So very often we see that if angel investor has got good advice, and usually we see people doing multiple investments. They would want to work with one person who can handhold them, who has got good knowledge on this and complete the transaction. Right now, you are working as a professional, you're working with one investor. You also get an opportunity to network with other investors who are investing in that company along with him, right? Or his circle. Hey, say tomorrow, I know someone who is doing this investment and I want to start off, I want to invest in a company. I'll approach somebody, say Mohit is a practicing CA who's offering this services. I'll say, boss, can you connect me to Mohit? I want to invest in this company, but I want to be doubly sure that I'm not going wrong or the company is doing everything right. So you get to network with similar investors. And if you're doing a good job, they will repeat. And whenever they don't want headaches, they'll say, boss, in a year I do 10 investments. I'll come to you. You manage everything. So we have seen this this is a very common thing. We don't even, when companies are raising money, the initial introductory call or meeting or an email sometimes is with the investor. He'll say, this is my advisor. Please, he will manage everything and he'll close the transaction for me. So this is very common. You also get to work with other investors, even if he is not introducing you. We have seen this very often. Say we are looking at a transaction and somebody is representing that investor in that company. We have discussions during closure. We find that this person is giving good inputs. We approach them. Hey boss, for our next transaction, we found that you gave good advice to your investor and you didn't waste everybody else's time. You know what you're doing. So we would like to work with you. Or somebody approaches us, can you put me onto somebody who can help me with this? We introduce you to such. It is all informal, but you have a great opportunity to network, right? Secondly, say initially you are the only investor and the founder is looking for help. You are representing the investor, but you step in and tell the founder, hey boss, this is how it should be done. You're going wrong here. This should be filed first. There's a clause in this agreement which doesn't look good. So the founder also thinks that, hey boss, this guy is giving me good advice. Why don't you come as a full-time advisor? And this is very common. What we have seen is early stage founders rely more on their network. He has a founder who started up or who is going to start up. He will recommend you. He has already seen the whole process. I would strongly recommend this firm or this person. Please talk to them. So this is very common, sir. There is good opportunity for members to expand their scope of clients. Not only clients, also scope of services. Say, you may have helped the investor only in income tax matters. But when you're working with him and the company looks at you, he'll ask you, I want help with some other auditing, internal audit, GST matters. So you have an opportunity to not only expand your client base, also your the scope of services which you can offer. And as investors, we see this very often. Because if I have to give a very practical situation, we invest. We are early stage investor. When we come in, some angel would have already been there. So when we ask the company who told you about this structure or who told you about these clauses which are already there, and we find that good, we think that we should get in touch with that advisor and ask him to work for us, because he has done all the work. No point in reinventing the wheel and getting somebody else and starting it from zero. So this is very common, and that's the reason that there's a lot of scope for members, not only in expanding their clients, also in the offerings scope of services.
Wonderful, yeah. And also you have mentioned that the fees is also quite good. Upside you have mentioned. So
Yes.
thanks a lot for that clarification. I will have to leave since I've got another commitment. Thanks a lot,
No.
and please do continue. Hopefully, I'll be able to see your recording. We'll also put this recording on our site, so people can who have missed this can also watch this. So thanks, Chetan and Mohit, Priyanshu. Bye.
Thank you very much,
Thank you,
sir.
sir.
Thank you
Good
for
day.
your
Good
time,
evening.
sir.
Thanks.
Thank you.
Yes, sir. So
Continue,
let
sir.
us get back to the earlier discussion which we have. This is just to recap. How can members engage with angel investors? What all areas they can work with? Like I mentioned, you're putting money into a company as an angel investor. That comes with minimal documentation. There is documentation going to be a document agreement. The three major ones are SHA, which is called as shareholders agreement. The second one is a share subscription agreement. The third is a share purchase agreement. These are the three basic minimum documents anybody can expect. Most of the times, we make one simple document to keep it easy and simple. We combine the SHA and SSA. High level, what is a SHA? SHA is like a Bible. After the investment round is closed, what are the rights? What can the founder do? What rights do investors have? What are the obligations, say, from an investor? As an investor, what all rights, information can you access? What's the board? What is the owners? Excuse me. What is the ownership? What are the things which a founder does? He can be penalized. What are we call it as cause? What happens if he does something illegal? How is it identified? What if it does something knowingly or unknowingly, but the event has happened? What is the recourse? All those things are recorded in the SHA. And this SHA gets revised or relooked at every period of time, mainly when there is a round of investment. And that's the reason I tell you that even if the angel investor is not making the investment in subsequent rounds, it is very important for the investor and his advisor to look at what the clauses are and give advice or update the investor on what the clauses he should be aware of. Right. The second one is called as a share subscription agreement. And this is a simple document where you tell in what's the price per share, what's the premium, the relevant clauses, what are the rights attached to each of the instruments, a CCPS or equity, all those things. Third was the SPA, which is called as a share purchase agreement. This generally happens when there is a secondary transaction. Now, what is a secondary transaction? You are selling or buying shares from another investor. That is called as a secondary transaction. The money does not go into the company. Say a company is doing well, and there is one investor who's already been there for 3 years. He wants to exit from the company. He will say, I will sell shares. Somebody wants to buy it. he will come in and buy the shares from the existing investor. As simple as that. The money does not come into the company. But why is it relevant? The SPA captures clauses say whether the buyer had real title to those shares, whether his rights will also flow to the new buyer, and what recourse you have if something goes wrong. Hey, if there is you have something called a section 281, he has a tax notice and his assets are taken over. What happens? Something goes wrong. What recourse do you have? So all those things are captured in the SPA. So high level, coming back, the investment documents mainly shareholders agreement, share subscription agreement, the share purchase agreement. Apart from that, the AOA and MOA, those basic documents, as an advisor, you will have to review. What are the rights attached to each of the securities? Like equity, it will be lowest in the liquidation preference. Say if the company does well or it is winding up, there is some money which the company receives. How much will each of the investor receive is called as a liquidation preference stack. So it depends on what kind of instruments you hold and where are you ranking in those stack, will be mentioned in the SHA, and also will be part of the equity instrument or the security you have. So it is very important for the advisor to understand, look at the finer points, and also update and advise the client who is the angel investor that hey, these are the clauses you should be aware of. In case you want to negotiate or discuss with the company or the founder, please do it now. Right? The cap table, like I mentioned, what is a cap table? It is a symbol of who the summary of the ownership of the company. Right? The founders, when they invest, say if there are two founders, there will be 50% each owners. Then you introduce ESOPs. You are hiring your team. ESOPs will be you allot. ESOP pool is created. So the founders dilute. Your initial ownership will be say come down to 45%, 45%, and 10% will go to ESOPs, which will allot to your future employees. Then investor comes in the first round. There's further dilution. So why it is relevant for the angel investor is, like I had mentioned earlier, your ownership is not going to remain constant throughout. Even if there is no round of funding, some conversion clauses may kick in because of CCPS or CCD, where it can be a convertible instrument in future rounds. You should be aware of what your current ownership is, whether do you have proper title, which is now it is demat, whether your shares are in demat, whether it's partly paid, fully paid, and is your ownership agreed and signed off by everybody in the SHA, right? And you should know what kind of dilution is happening in subsequent rounds. And say at the time of exit, you had put 5 lakhs or 10 lakhs and you had 5%. Should you increase your ownership? Because at the time of exit, you want to have reasonable ownership percentage also to have that big upside. Lastly, which I touched upon earlier, clauses like liquidation preference, waterfall, what are the exit rights, and information rights. So, as an advisor, when you're working with an angel investor, these are the kind of inputs the angel investors would look for. And it is our duty to understand, go deep, ask the relevant questions, and update the investor. The second part, where there's a lot of scope, is tax compliance. As advisors, you should advise that hey, if you hold it for say 24 months, it is but more than 24 months, it is long term. Less than 24 months, it is short term. So if there's an opportunity for the investor to sell, while the price may be good, you should advise the investor, say while the price is good, if you exit now, your tax percentage is going to be higher. So it doesn't make sense for you to sell. Maybe you can hold it for some more time and sell it so that net you gain more. Secondly, when you're entering a company, there are some rules like Rule 11 UA. High level, the investment by the angel investor should be done at or above the fair market value. Now, what is fair market value? There are different regulations around it. High level, if you're not complying with this clause, there was a regulation angel tax which we touched upon, which has thankfully been done away with. So it becomes more easier. But these valuation reports from again, what is a section? Again, from whom it has to be taken? the advisor has to be aware of, and also the angel investors should ask for those valuation reports from the company. Lastly, the regulatory filings, the allotment of shares, has it been done properly? If it's a foreign company, a foreign investor, whether FCGPR filings with RBI have been done properly. If it's a secondary transaction from a foreign, you are buying secondary shares from a foreign investor, whether FCTRS was filed properly. You don't want issues at the time of exit that these were not filed properly. Then the title to shares, whether these were allotted properly at the first place. Those questions crop up. Lastly, Section 281, as a member in practice, whenever your client who's an angel investor is selling, this is a common ask. The buyer will ask a certificate from the income tax department, or usually it's a certificate which can be signed off by the chartered accountant itself, saying that this is the tax exposure. He has filed tax returns. There is some demand. All those things will have to be issued, so you can work with angel investors very closely and guide them, and also issue them. Similar certificate for Section 81 in the GST Act, if at all the seller is registered with the GST department. So these are a few things where a very good opportunity for members to work with angel investors and guide and help them. The third one is due diligence. What is due diligence? It can be a financial or a legal or a tax diligence. Your client whom you're advising is investing in a company. You should advise, hey, I just want to check whether everything is right in the company, whether their incorporations are right. Are there any litigations? Are there any tax exposures which you should be aware of, based on which you may decide not to invest in the company? Or there are few things which you should be aware of, and those relevant clauses should be carved out in the investment documents. So it's a very good opportunity. You can, for wherever the angel investor is investing, you can have an arrangement where wherever I am going to invest, you will do a review and give me a report, so that I am aware of where I'm entering into. Share capital reconciliations, ROC filings, cap table consistency, related party transactions are all things which usually come up in diligence reports. The investors should be aware of. Lastly, this is one more thing. Say you can do a quick check if there's any litigation, background check, and appraise the investor and your client that, hey, I did the check and this is what it comes. I'm just cautioning you. It's your call. If you need more information, I can go deeper and try to help you. The last one, I think, is a very important thing, and I have seen in my network where people, angel investors, have made a lot of investments. They have advisors, but they struggle to get a fair idea of what their holding is, right? Say if somebody has done investment, say for listed shares, you go to your stockbroker, Zerodha or Motilal Oswal, you get a statement of what your cost is, what is your NAV, where the holding is, what is your daily profit and loss. All those you get it in a click of a button. But because we are dealing with early stage companies, and the information flow may not be that easy. And they say if investor has put a lot of put money in more companies, there's a very good opportunity for the advisors to tell that, hey, I can just manage the whole portfolio for you. I will tell where you hold shares, what is happening to those companies. We have seen instances where people would have put money and they have not tracked the company. Later on, we figure out that the company is shut down, and the investor is not even aware of it. Right. So you can offer your services to angel investors. Say, I will summarize your portfolio. I will come and sit with you every quarter. Obviously, the angel investors should have allow you access to such information, which is not a difficult job. So you can set up time, maybe annually, if it's not too much. Just get the investor gets a high level view. I had invested in 20 companies. This is the cost. I have held these companies for less than 12 months. These companies for less than 24 months. These companies I've held for more than 24 months. So my holding period is capital gain is short term, long term, or I'm closer to it becoming a long term holding, and what the current value is and what my ownership is. And if some document is missing, you should reach out to the company and get your title titles and documents in place. You don't want to be in a situation where you know that there's an exit opportunity, but you don't have information or documents which will enable you to sell your shares. And with all holdings going to a more simpler and easier format of DMAT, going forward, it is going to be more easier to track. But there's the shift from the physical holding to the DMAT holding is also one area where people will need assistance and advice. I think I've covered periodic performance. Regularly the company will send EGM notices. There is some corporate action. You should, if it's part of your scope, you should read it on your and appraise the advisor. Hey, because of this action, this will what happen. This will what will happen to your holding. It is a very good opportunity, untouched. I have seen a lot of people struggle even after engaging people, their existing advisors. So I think it's a specialized service. It can't be like that, hey, I have free time and I'll get into it. There is a lot of requirement. And again, I stress many people in our network struggle to get this simple thing every quarter or every 6 months. Now, all of these angel investors have to file their tax returns. They have to struggle, get information from, say, if I've invested in 20 companies, it's a headache to reach out to 20 companies and collate all the information and file your tax return. So I would say this is a fantastic opportunity for members in practice to look at this and advise their clients. So all this while we concentrated and spoke about what are the opportunities members have in working with angel investors whenever they're investing in a company. Now I would like to touch upon how, and we briefly discussed when Madhukar sir was there, on how you can engage with companies. Without repeating what I've discussed already, the incorporation advice anyways is there. How to get investors, what kind of instruments, what kind of investors. But whenever there's an investment round happening, there is something called as a term sheet which the company gets. It can be from an angel investor or any other investor coming in. Term sheet is a letter of intent. It is a summary, a concise agreement where an investor says, hey, I want to invest in your company. These are my terms. I want to invest high level. I want to invest this much of money for this much of ownership, and XYZ are the investment rights which I want. And this is the current shareholding, and this is the post shareholding after my investment is completed, right? So this is a very common document which comes to the company whenever there's an investment round happening. And many times the founder wants advice from people who have knowledge in this on what are the implications of agreeing to or not agreeing to a particular clause. A simple thing can be, hey, I want the audit to be completed within 120 days or 90 days. Now, what happens if you don't complete the audit and share the audit report with the investor? Say every month MIS has to be sent out within 10th of the next month. Can you send it out in 10 days, sorry. If you don't send out the MIS in 10 days, what happens? So those kind of summary items will be there in the term sheet, which will be actually detailed. The discussion and the fine print will be in the definitive documents, which is the SHA later on. But the initial first step, whenever a term sheet is received, there's good scope for the advisor to help his client or the founder to understand what the terms of the term sheet are. Again, due diligence. Somebody is going to invest in the company. Their DD teams will come. The transaction has to be closed fast. It is always good. You clean up whatever information is required. You prepare a data room, do a pre-DD, clean up, identify what the issues are before somebody else comes and say this is not done. It can be simple things. You set up the data room and help the company close the transaction process faster. See, for any company, when they have to raise money, it's a very a lot of time is required. If usually average, we say 30 to 45 days is when a transaction round takes place. After that, there's a deal fatigue. The founder has to also do his routine job. He has to get back to his, he has taken money, he has to help the company grow. So whatever support as an advisor you give to the company to help him close this process faster and give the right advice will be very valuable, right? That's what I meant by founder project manage the investment round. You, as much as load you can take off from the founder's shoulder, he can do other things. and you can help him and also be paid for whatever services you're offering. MIS review and monitoring. Every month you've signed up with the investor to send MIS. You can prepare the MIS, clean it up in the way, in the format the investors want. You can discuss with the founder, hey, this is how the MIS looks. These are non-financial matters which are getting in, which I don't have a hang on, but are they talking to the numbers? Please look at it and then send it out to the investors. So you are sending the numbers which you got are more credible. Right. Lastly, post-closing compliance, you have a round, you got money, you have done all the things, DD is done, the share allotment, everything is done, valuation, all is done. There are few clauses which we call as condition subsequent and CP completion. Condition subsequent and condition precedent. What are these? Condition precedent is we identify, say the investor, his team identify few clauses in the DD. Simple one, yeah, somebody has not paid TDS. Right? So you put it as a CP or a CS. We'll say before we close this round, please pay the TDS. That becomes a condition precedent to close this round. Only after you pay that money and show it to me, then I will wire the money from my side. If it is not too grave, we'll say, hey, I didn't have money to pay TDS. That's the reason I have not paid this TDS. Once you put the money, say within 30 days, I have funds now, I'll pay the TDS with interest and penalty. So let us move it as a condition subsequent. So these things are identified during a diligence. That gets recorded in the transaction documents. So who will do this whenever one is the investor and his team have identified, but who is going to take this up, advise the founder, hey, subsequent, this is a CP, but can we request them to move it as a CS so that we don't waste time? Let us get the money, but we'll agree to do this, say within a definite period of time, and I will take care of that. You don't have to worry. I will manage the whole process. So these are few things which I think a company or a founder early on would like to get help from his advisor. And we have seen that proper advisor, good advisors help close the whole transaction process on time efficiently. You don't want to be negotiating on clauses which have no relevance, right? Whether TDS is not paid is a issue, but why did he not pay? He did not have funds. Okay, does he agree now to pay TDS after we put in money? Yes, fine. But there are other important things where the founder would like to discuss with the investor rather than the things which are not that important. Lastly, like I told earlier, I would like to discuss practical aspects which we have seen when I have seen people in my network doing angel investments or my friends or companies wherein we are investing or and an angel investor is participating with us or there's an existing angel investor already. There's a lot of scope for members to network, which we have already discussed. You help the angel investor or the company, you do a good job. We have seen this very often. Founders recommending advisors who they have worked. They might not have been able to pay initially to the advisor or the CA firm, but as they grow big, they would want to be associated with you. More doors can open up, say internal audit, stat audit, tax advisory, GST, because you have helped them early on and he knows that he'll get right advice. He would want to work with you rather than getting somebody else into the system. Similarly, he or she will, and this is very, very common again, startup founders, they will look up to their seniors or whoever has done it in the past. Hey, can you put me onto somebody who's already done it? And this is my ability to pay fees. Will he be able to come and work at this fees? So you get referrals. Same thing, it opens up more doors. Again, I strongly tell my colleagues, my friends, that it's an investment you make. Many times, early stage founders will not be able to pay fees because of how much of money they are raising or the complexities involved. There's an opportunity for advisors to actually also get into company with the angel investors. Say, I like this company. Can I get opportunity to invest in company? Deal flow is a very important thing. There may be very good companies, but do they also want money from you is a question, right? So if you're working with well-known angel investors, or good companies, you have an opportunity to invest in those companies also. Many times you have seen you have money, but the company doesn't want to take money from you. They want not only money, but advice from people whom they're raising money from. So it's a good opportunity for you to get into the company. You can work with the company here. I know that you're not able to pay money, but I will take nominal money, but I also want to invest in this company. Please allow me, so that you get the good upside later on. Tax litigation support, which we have already discussed. Incorporation, very, very important. What kind of structure to be put in, where the company should be incorporated. So not only for now, the kind of investors you're onboarding, but for future rounds, once the company expands. Very good input. I think there were a lot of scope for members in practice to work with companies and also angel investors, so that they can advise the founders of companies where they are getting in, and tell them that we have seen this, these are the consequences, and work with those companies. Again, it is not only resident Indian investors, a lot of non-resident investors, NRIs, they want to put money. What are the requirements? What are the complications? Indian investors, they want to invest in overseas companies. How can it be done? What are the restrictions? What kind of instruments can you take? How can you exit? All those things. We have seen cases where there's a parent company and a subsidiary company. Somebody wants to put money in a subsidiary company. Will the company, company is taking money because of transfer pricing restrictions and all those things. Will the company be able to utilize the money which they have got into the entity? It can be a parent or a subsidiary. So those high level advice, even before the investment round is closed, the advisor has to look forward and raise a red flag or highlight it to the company or the investor well in advance, right? Again, it's a long-term game. Early on, you help companies and founders. They will value you that you help them structure it in the initial days, and you stick on with them for long. You will be rewarded not only with fees, the opportunities to work, and if you have taken advisory equity and all, the upside is high. Apart from the networking and other service offerings which you can offer, right? Lastly, all of us look for a trusted advisor. More so when you are an early stage founder, there are too many things running around, too many things to manage. If somebody can step in, hey, I have done this, don't worry about it. I will manage this entire piece for you. That's what the founder is looking for. Same for angel investors. They might be doing a lot of other things. Say if it's just to give an example, a lot of cricketers we have seen, a lot of actors, a lot of entrepreneurs who are doing something else full time, but they have made investments in these companies. They want somebody trusted who they can trust that, hey, this part of my unlisted angel investment portfolio, is it with the right advisor? When I'm looking at my overall portfolio or my net worth to file my returns or to know where I am, at least this part I know is proper, somebody has taken care of. Other things which are not with this person, I can take care of. So that kind of support is very much needed for the founders and angel investors. So I think I've covered most of the aspects. From valuation services, if I have to tell, Section 281 reports, 11-year reports, 56(2)(10), Section 68, Section 79 of the income tax, all these areas, a lot of gray areas, the founders will not know. You can step in and say, these are the implications. Capital gain, lot of tax areas which we have been doing. Not that this is something new. It is just that you have to make it as a structured package, understand what the needs of the investors are, and also the company, and put it in the right way. So Mohit, I think I'm done with my presentation. Anything you want to bring up? Maybe after that we can open it up for questions.
Definitely, sir. It was a worthwhile session. I had some questions with at the question answer panel. Should I ask you right now?
Yeah, please. Yes,
Okay.
please go ahead. Yes.
Sir, there is a Regan Kapoor. He's asking, sir, what is the difference between the angel investor and the venture capitalists?
Okay. A good question. Like I had mentioned earlier, I can go back to the slide. So, in simple words, angel investors put their own money and they come early on. They are not relying on others' money to say you're a salaried employee, you have earned money, you have surplus money, you want to put it in a early stage startup. This is called as angel investing. Now, what is venture capital? Venture capital is money manager, if I have to put. VC will take money from other investors, pool in the money. It is not their own money. Partially, it can be their money, but they are taking money from others, and then they are investing into the company. That's the main difference. And stage wise, angel investors usually come in first. Like I mentioned, it is usually your friends and family or angels with whom you want to take money. So that you can show that initial traction, build what you want to build, and then go to VCs and raise money. See, also for the founders, it is a dilution game. You don't want to dilute too much early on, right? So you don't want to raise less equity and dilute more and give away equity early on. So that's a thing which founders have to keep in mind. But to answer the question, angel investors is their own money. They invest into the company. And VCs are more institutional investors who come in little later, or with angel investors, they take money from others and then put it in the company.
Okay, sir. Good. There is a question from Jay Prakash Jain, sir. Is angel investors are supported to MSMEs? If not, then what type of system or infrastructure we can suggest government and our CAs can do this?
Yeah, see, most MSME, all the early stage companies are MSMEs. All these companies can take registration with the startup initiative of the government, and they can also whenever the companies take registration with these MSMEs and startup programs of the government, they get some benefits. So investors, the CAs can advise companies that there are these things which registrations are available. What is the benefit by taking those registrations? And they should advise their companies to take such registrations. And opportunity, if I heard it right, what opportunities they have to work with MSMEs, we have already discussed. What schemes government is already working on a lot of things for early stage startup companies. Like I mentioned, they have set up a separate pool of money, which is called a fund of funds, which is dispersed indirectly to startup companies. Like we have SIDBI, the government of money will put in money into SIDBI. SIDBI will identify companies or VCs from where this money can be put into those companies. SIDBI will have, I'm just taking one example because I know that SIDBI has this. SIDBI will tell that, hey, will tell the VC that whichever company you're investing, make sure that a portion of the money goes to MSMEs or early stage startup. Now, what is a startup? They have given a definition. So that is how government is already working. We'll have to see how things go forward and what suggestions can be made to the government. But government is already doing these things to help early stage companies and MSMEs.
Okay. Sir, Ravi Shankar ji is asking, is PitchBook is a good platform for this? PitchBook?
I can't comment on that, but there are a lot of pooling vehicles, right? What is a pooling vehicle? Say now, if a company is raising money, there are 20 angel investors. To manage 20 investors, it becomes very difficult. Company will say, boss, I don't want to manage 20 people. Every quarter, he will ask me for one thing. The one more investor will ask for something else. So I don't want the headache of managing 20 people. So I want one investor where they can put in all the money so that I talk to one representative of the investor, high level, right? Now, you also want, as an investor, access to one of these companies to put money in. And also, you don't want the headache of all the DD structures and all. You want to put it is like a mutual fund, put a simple word. So this is one of them, I think. So it is called as roll-up structure or a pooling structure where investors will come into one structure. It can be a partnership firm. I'm just whether it's legally allowed. We'll have to look at each of the jurisdictions, or as a trust, angel funds, which is registered with SEBI. There are restrictions, like I mentioned earlier. Just let me tell. Now,
Okay.
SEBI has allowed angel funds, registered angel funds, where individuals can come and they can pool in money. Now, there are few restrictions on how much net worth should be there, what kind of investors can put in. So what is the advantage to the investor? You are going through a structure. The company is okay to take money. They don't have to deal with 20 people. As an investor, all the basic things of all the secretarial compliance, the tax compliance is taken by this pooling vehicle and they charge for a fee for it. But the only disadvantage there is because you are going through a pooling vehicle, there are 20 other people with you. If you want to exit alone, you will not be able to exit. The entity will have to exit from the company. So if you have 20 people, 19 may want to stay on, but you want to exit for whatever reason, you may not be able to do it.
Got it. Mm. Sangratan ji is asking, is angel investing is for a shorter period comparatively?
No, like I had mentioned in this slide only, it can be shorter or longer. It depends on what you want. What we have seen early on is angel investors come in, then there are a couple of rounds. The company also wants to clean up the cap table. What I mean by clean up is they want to deal with lesser number of investors, right? Now, as an angel investor, you're already in the company. Your risk appetite is only that much. You want to exit after 3 years. You can do a secondary sale and exit out of the company. So there is no right or wrong answer. Average, we have seen that many times you've seen it, people exit in 1 year and 2 years also. So average, I would say, is 3 to 5 years is a good range. See, also if the company is doing well, you also don't want to leave the upside. You don't want to leave money on the table. You want to be associated with the company as long as you want to, right? It depends on you. Average is about 3 to 8 years. 5 years is a fair number.
Okay, sir. Krishnakant ji is asking, why is better CCD or CCPS? Which is better? It must be. Which is better, CCP or CCPS? Do we need to valuation reports for issuing CCPS and CCDs?
Valuation report is required. Answer is yes. Now, what is CCPS? CCPS is compulsorily convertible preference shares. Now, why would someone take a preference share? Is one, because you have better rights than an equity shareholder. Whenever you have an exit event or there is money liquidity in the company, you will have a preference over equity shares. That is theoretical, right? Now, CCD, why would somebody want a CCD? Is say most of the times when you are doing a convertible round. Say the founder is taking money into the company, he doesn't know the valuation. He will say, boss, I don't know how much of shares to give you, but you want to put the money there. You will say, okay, I'll do a convertible round. Whenever the next round is happening, you give me 20% discount to the next round. Why? Because I've already come in now. And you are also fair that you don't know how much equity dilution you want now. So I'll put the money now and I will take a discount. Say somebody is putting 100 rupees in the next round and is getting 10%. I put 100 rupees now, I would take 13% next round. So I'll get a discount to the next round. I'll get more ownership because I put in early. Those kind of situations we've seen CCDs. There may be other situations where somebody has put CCD, but mostly why CCD and it is also compulsorily convertible instrument, right? So I would rather go for a CCPS. The only reason to do a CCD is when the valuation is not known and I want to do a convertible round next.
Okay. Om Prakash ji from EIRC is asking, what regulations cover crowdfunding?
SEBI regulations govern crowdfunding. There is not everybody can pool money and make investments. There are guidelines. There is a pooling of interest regulation which SEBI oversees. So SEBI will be the overseeing body. Income tax is not bothered because they are bothered whether you have made money and paid tax. SEBI will be the governing body. They want to discourage unstructured, unauthorized pooling vehicles where people are taken for a ride. SEBI is very, very particular on who can pool, what kind of structures are allowed to pool money and invest in companies.
Sangratan ji asking again, can CAS be an angel investor along with performing advisory services?
Answer is yes, as long as you are not doing attest service or audit service. In my opinion, I think you can do both. There is a part of there will be a bias. There will be some related part because you're already an investor and also you're an advising company. As long as other people, investor company are okay, it can be done. But as a good practice, I would discourage somebody to do that.
Some questions I had written is, you mentioned angel investors come in early. How do they evaluate startups then who are not having strong financial yet?
Sorry, can you repeat the question? I didn't get it.
how do the angel investor evaluate the startups when they are not having the strong financials
Okay. Yeah, that's a good
at
question.
at early stage, specifically
Yeah,
at
yeah,
early
it's
stage?
a very good question. See, early stage, you're backing the founders and what is their track record, right? It is the idea you're backing. They may not have numbers to show. It is their past record. It is the in simple words, you're backing the founder, what they have done in the past, what is their credibility, and their capability or ability to execution. It's an execution game, right? When early stage founders come in and they're raising money, everything is on paper. Whether they are in the right market is for you to evaluate. It can be a great founder, but they can be in the wrong business. So for whether they're in the right business or wrong, it's for you to evaluate and then put the money in. But it's execution game. You're backing their credibility, their track record, and their ability to execute.
Okay. Devansh Soniji is asking, some CSR trusts create donation through crowdfunding. Is it some CSR trust create donation through crowdfunding? What he
Sorry,
is
I don't have
asking.
any inputs on this. Sorry.
Even though,
Yeah.
okay. I'm asking one more question from my side. Is there any minimum investment threshold for somebody to be considered as angel investor under SEBI or RBI guideline? Minimum
No.
investor from
No, there is no
there is no.
minimum investment. But see, for you also, like, and it's a repetition, for the company also, they should have meaningful money which is coming in. And for you as an investor, nobody stops you from putting 5,000 rupees or 10,000 rupees also. But does it make sense? All the process, the costs which are attached to the whole round, the documentation. So it has to be commensurate with the kind of money one is raising, and also the money you're putting in the company.
Okay. Is angel investing limited only to tech startup or other sectors also?
No,
Basically,
maybe I would have spoken more about tech because we are a early stage tech startup, and I've been in this space for a long. I'm sorry. It can be in any, like I told this in the beginning of my presentation, it can be in any field. It can be real estate. It can be a manufacturing industry. It can be in anything. It is a business somebody is starting, right? And also, I've seen it need not be a private limited company. Also, I've seen where partnerships were incorporated first, somebody has put in money. How that takes shape later on is a different thing. Whether there's a right structure, it's a different thing. But anybody who is starting a business and who is raising money and somebody is putting their own money is known as angel investment.
yes, sir. Good. Can you give some light on tax implication of on angel investor at the time of exit, especially in case of capital gains?
Yeah, it is as there's nothing different from any other asset class. I'm talking about early stage
Sure.
companies where you have equity or CCPS shares with you. You have held it for more than 24 months. It is known as long-term capital gain. Depending on and then the normal whatever the current rate of tax and surcharge apply, they apply.
Okay. And for in case of overseas angel investors, what kind of complications, yeah, compliances that need to be kept in mind um, about that RBI or FEMA, something like that. There are any compliance we had to follow for that?
Yeah, a very good question again. See, overseas investment is where you are an Indian resident, you have INR with you here, and you want to invest in a company which is registered outside India, right? Uh,
Yes.
Directly, it is not allowed. There are a few regulations which have to be followed. Say you want to invest in a company in the US or USA, sorry, US or Singapore or any other jurisdiction. One, you have to understand whether what is the quantum you're allowed to invest directly without any restriction. There is a LRS limit of 250K. Many of them use that route to make investments. Again, there is a gray area whether LRS is the right route or not, but a lot of people, it's very common for people to take LRS route. There's a 250K, $250,000 per annum. Each person has a limit, 250K. You can use that limit and make investments overseas. Again, there is a gray area. There's a lot of debate whether LRS is the right route or not, but it's a common practice. Let's come to the second one. Second, there are other pooling vehicles where you can do through a ODI route. As an individual, you're not allowed, but you can go invest through an entity. Lastly, which is a more longer process, is you want to invest in an overseas company, you go to RBI and get the permissions and invest in that company. But
And
also, you have
ask,
to keep in mind is not only investment, what kind of investments, what kind of instruments are you taking? Point number one. And at the time of exit, what's the route? How much, where you can get the money is also a thing to be kept in mind. Also, to disclose sufficient information in your income tax returns. We had seen a recent article in the newspaper where many of the employees had got ESOPs of their parent companies where they are working. All of us thought that this is not required to be disclosed in our income tax returns, but this is a holding in a foreign company where you have shares that has to be disclosed. So smaller
disclose.
points like this, as advisors, people look out to chartered accounts in practice or people who are in this field. Proper advice and guidance is required.
In your point of view, what are the emerging sectors or trends should angel investor keep an eye in 2025?
I think it depends on what the investor wants to look at. But if you ask me personally, I think technology, mainly AI, and I forgot to mention AI is the buzzword, and the city where I come from, everybody wants to do everything in AI. But that is where we feel that technology can leverage business and the opportunity to grow is higher. So in technology, artificial intelligence, any company dealing with that, e-commerce, anything where technology can be leveraged and can be grown online. It can be healthcare, e-commerce. I personally feel there's a lot of opportunity. Fintech again, not it is fintech. I mean, there are a lot of already payment companies already set up. Anything beyond payments, fintech, there's a lot of opportunity. I think this healthcare again. These are few areas where I feel there's a lot of opportunity for growth.
Okay, fintech you are asking for. Can you walk us through a real life case of a successful or a failed angel investment and the lesson behind it?
Sure. Just last week, and this is a practical thing. I was talking to two friends. They had invested 5 lakhs in a company. And again, why structure is important. And again, I emphasize that what kind of structure you're entering in is very important to get in. This was they had invested in an Indian company. For some reason, the company had to be flipped, or the parent was in the outside India. The parent was in US, and these people had put money in India company. How they did it is a separate question. But these people put 5 lakhs in the company, and because of some regulatory issue where they were not able to flip their ownership to the US parent, they got 2x return and they were happy with it. And in 6 months, these things don't happen very often, but in 6 months, there was the last round which came in, and I think the other investors got 20x exit. This is there's an opportunity there. Again, this will not happen with all the companies. The mortality rate is high. Early stage companies, many of them will not work out. This can be an outlier. So I have seen these kind of cases where it has worked and not worked too. But we have seen this in news where a lot of well-known, most of us would have seen Shark Tank. All of them are well-known angel investors, and it is public news on which all companies they have invested in. Companies which have been in the news like Flipkart early on, whoever the angel investors were. I think recently there was a news on Urban Company where early on angel investors have made really good exits. The upside is large. So there are it can go two ways. People will not talk about things which have not worked well for them, but you will hear more news about the positives.
Negative.
But it's a risk appetite of the investor. I'm not saying that somebody should not do it. As long as you have the risk appetite and understand that it's a risky asset, there is no harm in going ahead with this.
No, sir. CA Abhimanyu Nandaji from CARC is asking, can a company be an angel investor where one should get registered for becoming an angel investor?
Now, again, the screen which I've been sharing, there is something called an angel fund. It is an AIF which has to be registered with SEBI. So you can look at those regulations and get yourself registered or become an investor in an angel fund. There are a lot of, again, angel funds pooling vehicle which allow investors to come in, pool money and invest. So if you want to go through a regulated thing, please look at angel funds
Yeah.
regulations under SEBI. AIF,
Okay.
Alternative Investment Funds. They're called as AIF. Under that, there is something called as an angel fund.
Okay. Sir, what are some red flags? I'm asking personally for you. What are some red flags you are thinking the CA must watch when conducting the due diligence of an II?
Okay, a very good question. See, due diligence, I'm talking mainly from a financial due diligence and a tax due diligence. I'm not touching upon business diligence and legal diligence. While the CA can also do all of these, from a financial due diligence, I would high level see whether the numbers which are being shown are correct. There is now something not which is apparently wrong, right? Whether the incorporation is done, whether, okay, simple thing I'll tell you, whether the director is qualified to be a director, whether the company has filed annual returns, whether can, okay, one is the issues like this, can it be corrected or not corrected? Right? Early stage companies, nothing, most of the times the mistakes will be there, but whether it is intentional or it was lack of
Knowledge.
ignorance, lack of knowledge, right? Somebody, like common thing which we see, we have a subscription, somebody has paid it from the credit card, whether TDS was to be paid or not, whether 15 CA, 15 CB form was required or not, right? Early on, you bought it from some relative, so you got a related party transactions. Very clear red flag, right? Whether the numbers, which is mainly the revenue, whether they are true and correct. Now, revenue recognition can be wrong. Whether you have to recognize revenue within this financial or the next financial year, unrealized, unearned revenue, those kind of things, it is an accounting issue, right? But whether the revenue was real, was it collected later on, those kind of things are things which, and see, again, somebody wants to do fraud, it is very difficult to find out unless you do an investigation. But are you looking at any indicators? Is it a repeating pattern? Do you see any red flags? Those kind of indicators, whether you want to double down, is what FDD is. Now, somebody has not taken a PT registration. Is it an issue? Answer is yes. But can it be corrected? Yes. So will it come as a CP or CS? High level FDD tax was in any litigation? Is there any open litigation? Whether they have paid all their past dues, whether their carry forward loss number is correct, have they filed their tax returns? Was there a revised return which was filed? Why did they file a revised return? All those kind of things is what we look at. But high level, it is whether the numbers or the overall functioning is fairly okay with these kind of errors which can be corrected, is what we look at.
Okay. But these are the important questions which had to be answered, and you had answered it so perfectly that I think all the audience, I can see the number of person who are available at this portal right now is more than 550. So it's a worthwhile session to have you at this platform. We are very kindly obliged by this session. So, is there any more questions, and we can conclude it, sir?
Yeah, nothing
Okay.
else from my side.
Okay. So thank you so
I
much,
would like to
Chetanji.
thank.
Yes, yes. Please, sir.
I
Please.
would like to thank the CA Institute and CMP team, Madhukar sir, Vice Chairman sir, you, Priyanshu, Shubham, everyone, one for giving me this opportunity. And also, it is very nice to know that the CA Institute is looking at expanding beyond the regular streams and also trying to help the members and educating them. This is very nice to see. Thank you so much and wish you all the best.
Thank you. Thanks to you, sir, for such kind of wonderful deliberation. Thank you so much for such eye-opening and inspiration session, I must say. You had made the talks, the complicated things which are so much complicated in various way. Even in our daily life, we found various business are coming, they are having a lack of fund, they need an investor who can bring them feathers that they can fly in a colorful way. So, but in case we are having a hesitation about that, how how it will work, how the people will get the entry point, what are the exit points, what the precautions we had to keep in the why. You had covered the complete way out of this session in this session, sir. So I'm sure many of us now thinking, ये तो हम भी कर सकते हैं, sir. Now they will definitely you are giving a new way open for this. So thanks a lot. Thank you a lot, sir. And thank you to all the audience to be interactive and for asking the questions regularly. Thank to the tech team and the CMP committee. This is all from our side. Thank you all of you.
Thank you everyone for joining this webinar. Thank you so much.
Thank you. Thank you so much. Yes.